Hello and welcome to Indianomics. No prizes for guessing what is the story of the week, of the day, of the moment. No, it's not even the depreciation of the rupee, but steps taken by the Reserve Bank to put a floor to the rupee. Just to summarize the actions of the past 7 days, the Reserve Bank on 15th July said it won't give more than 1% of the total deposits at its daily repo window, that is 75,000 crores. And that additional money will be available at the MSF window only at a higher 10.25%. It also said that it will sell bonds in the open market to drain 12,000 crore rupees. The result, on July 16th, call market yields shot up to 9.5%, 10-year bond yields shot up to 8.12%, and 9-month CDs, certificates of deposits, maturing on March 2014, quoted at 10% from just 8% 24 hours earlier. To put in a nutshell, bonds fell by about 5 rupees, but the dollar rupee fell by just 75 paise at the maximum to 59.20. It appeared at one point that the Reserve Bank was ready to see even lending rates in the system rise to save the rupee, but by Wednesday the resolve appeared to have diluted a bit. Both the Treasury bill auction on Wednesday and the bond sale on Thursday were allowed to flop, leaving the markets guessing as to whether the Reserve Bank was not prepared to push rates too far to save the rupee. So what we have is a set of short-term steps taken by the Reserve Bank, its slightly medium-term options and its longer-term options to stabilize the foreign currency, the exchange rate market. To address all these buckets, to address all the questions relating to the exchange rate, I have with me a very eminent panel. Former RBI Deputy Governor and currently Director of Research at Brookings Institute, Subir Gokarn, Arvind Subramaniam, the Senior Fellow at the Peterson Institute of International Economics in Washington. He joins us from Washington. And Hitendra Dave, Head of Global Markets and Managing Director at HSBC India. Gentlemen, welcome. Hitendra, let me start with you. What is your sense? Is the market now of the view that the Reserve Bank does not want to push rates too hard, pay too high a price in terms of economic growth to save the rupee? Or is it going with the view that no, the steps have been only temporarily rolled back, that the Reserve Bank would take even rate rising steps to ensure that the rupee gets a flow?
My own sense is, I think, looking at the fairly sizable reaction in the fixed income markets and the potential for those then to create another source of problem. You are trying to address instability in the FX markets and are trying to anchor expectations there. But in the process, if you de-anchor rate expectations or yield expectations, when the economy clearly cannot, is possibly not ready for those kind of situations, I think it's those thoughts which I think appear to have reflected in RBI choosing that, okay, while we want to focus only on the FX market, if there is turning out to be a significantly higher collateral damage into markets which are actually not directly benefiting your intended market, I think it's those measures which I think they have accordingly tried to help the market with.
Okay, so the follow-through would be, what would you expect the Reserve Bank to do? Purely expectation, not what you want the Reserve Bank to do. Since they don't want to disturb yields too much, would a CRR hike be the logical conclusion? What are you going with as a market man?
No, I think at least the last 4 days, what it does tell you is that the assumed link between interest rate and liquidity, domestic, and the exchange rate level is perhaps not as strong as might have been believed while taking these measures. I think most market participants will tell you that there is very little onshore speculation which is taking place. Banks are in any case controlled by the Reserve Bank of India, and the positions are quite micro-managed and micro-known. The positions taken through the currency futures market, both by banks and by non-banks, had been in any case taken care of through certain measures effected 2 weeks back or so. But having taken these measures, I think the main signal was from the Reserve Bank of India and possibly from the authorities in Delhi also, that we want to anchor expectations vis-a-vis the rupee. So this measure having been taken, and I think it's too soon to say whether it's working, whether it's not working. I think from a market perspective, the fears of further action, be it rate, be it liquidity, be it CRR, will remain till at least, I guess, we see the policy document, which is the one one big place where you will get clarity on what exactly are RBI's thoughts going forward.
Arvind, a couple of central banks or several central banks have already used the rate weapon to put a floor to their respective currencies. What is your understanding of the fundamentals in India? Do you think that irrespective of what happens to growth in the process, the Reserve Bank needs to use the rate hike weapon, or maybe a CRR hike, to ensure that the rupee is first stabilized? Should financial stability be given that utmost importance?
There are two possible diagnoses. One is to say, look, all that's happening is predominantly determined by the external environment, notably by what the US Fed has been doing. Then, there doesn't need to be much of a response. So one way of interpreting what the RBI has done is that, essentially it's in a thankless job. Two objectives, or actually multiple objectives. It has only one instrument, and it's trying to juggle that. On the other hand, if your diagnosis is that it's actually partly external but much more fundamentally what's going on in India, then I think you would have to step back and wonder whether the RBI was in fact right in pulling back. Because if you think the problem is much more India driven, i.e. there's a fundamental problem with growth, macroeconomic stability, and really you need much more action from the Indian government, both the government and the RBI, then I think some tightening of policy is unavoidable. Because that's the way you anchor the rupee. Otherwise, the markets are skittish. We're heading into an election year. There's no saying where the floor is going to be. So it really depends upon what your diagnosis is. I would, frankly, lean towards the latter diagnosis, that it's not just about the external environment, a lot to do with fundamentally about questions about the Indian economy, and therefore India needs to take much more action to kind of stabilize the rupee and re-engender confidence that things are on track.
Okay. Well, let me put the same question to Dr. Gokarn. What is the sense you would have in a situation like this? Is it very important to first give a kind of financial stability and therefore put a floor to the rupee? And should the price of sacrificing some economic growth be paid and rates be hiked? Are we in that situation?
To my mind, we are facing the consequences of a structural problem. The external environment, the announcement by the Fed about tapering was certainly a trigger, and it did initiate the process of adjustment that we saw the last few weeks. But the significance and the magnitude of that adjustment was essentially the result of the vulnerability that we face. And this has been hammered to death, but we have to continue to make the point that the size of the current account deficit is our biggest indication of vulnerability. So when you're dealing with a problem which is essentially structural, it's pretty obvious that temporary measures, whatever they are and however effective they may be, will not address that structural problem. I think the way to see it is that if you are going to do anything, and the measures that were taken on Monday were a reflection of that, to stabilize the rupee in the short term by affecting expectations or whatever, in this case directly by impacting the supply of the rupee, which makes it scarcer and therefore presumably more attractive. These can only work if there are clear signs that the structural problems are also being dealt with. Now, if we don't have a sort of parallel movement or simultaneous movement on the structural issues, that is, announcements that are actually addressing the causes of the problem, the vulnerability, then I think the effect of such measures, however strong they may be, will peter out over a period of time. I think that's the risk that we have to deal with.
What I'm asking you, Dr. Gokarn, has the time arrived to actually go ahead and hike rates for the moment, to probably even take out some demand in the medium term from the system, kill growth a little more, as well as show the resolve to protect the currency? Have we reached that stage of raising rates?
Well, as I said, I'm constrained from making specific recommendations or predictions on policy actions, particularly monetary policy actions, so I will not do that. But I think we can make an assessment of the pros and cons of different measures. Now, we are in liquidity. The short-term issue is liquidity. We are suffering a shortage of dollar liquidity. There's no question. There are two ways to change that situation. One is, as you're arguing, by raising the rates, if I were to get textbook textbookish about it, and now since I'm supposed to be an academic, I suppose I can afford that luxury, that you want to move along the supply curve by raising rates. That is, you're inducing dollar inflows by offering higher rates. That's one way to do it. The other way is to shift the supply curve, which is at the same rate, find ways to get more dollars into the system. That then opens up the possibility of various other measures. A lot of talk about bond issuance, whether it is short-term, long-term. Perhaps there are bilateral options. We have a line of credit with Japan. Perhaps there are multilateral options. There's been occasional talk about, approaching the IMF and so on. It hasn't gained much traction. But I think when we look at the realm of possibilities and the solutions that we have to address, even from a short-term perspective, we should not be confining ourselves to only one action. We have to consider the pros and cons of either moving along the supply curve or shifting the supply curve out. Both of them will have pros and cons.